Friends, I, Captain Vivek Jain, welcome you all to my 17th episode. In our earlier discussions, we have learned about the fundamental analysis of any company, which tells us its quality by way of understanding the financial parameters. Financial parameters. Through study of the company's balance sheet, income and expense statement, and various important financial ratios. If the company appears to be fundamentally sound, we can also discern from the price behavior of the equity shares in the stock market during the recent past the trust that the investors repose with the management, the returns that has been reaped by them, and accordingly our own interest develops in becoming part owner of its business by purchasing its equity shares. Purchasing, friends, purchasing at what price? The current price, the prevailing price, the price at which it is available. Is it the correct price? Or is it undervalued or overvalued? So many questions are there, but what is the answer? In this regard, allow me to relate an interesting query put in by a stock market enthusiast to the great investor Warren Buffett. The query was, "Sir, when do I buy an equity share?" The reply was equally prompt and to the point. Buy when you have the money. Friends, it was in jest, but the fact remains that we all would like to buy anything in our lives at the correct price. And that correct price in stock market is popularly known as the intrinsic value. And what is the intrinsic value of the equity share? This is what I had stated in my previous episode and will be the subject of our discussion now today. Friends, I start my presentation. Intrinsic value. The definition of intrinsic value is it is the anticipated or calculated value of a company's equity share and is also called the real value, which may or may not be the same as the current market value. There are several formulas devised by experts over the years for reckoning the intrinsic value of an asset or an equity share. Here I have selected the three most popular ones for your benefit and understanding. The first one is known as discounted model. The fundamental or the intrinsic value of a business or its equity share is generally considered as the present value of all future cash flows, discounted at an appropriate discount rate. By future cash flows, we mean that when you purchase an equity share, you will definitely anticipate or expect, apart from the dividends that the company may give, the capital appreciation in the stock market year after year. Of course, in the long term, this capital appreciation is easily discernible. But however, after the capital appreciation, one calculates it annually always. This annual capital appreciation by way of calculation after 4 years, 5 years, 10 years should be in a very reasonable manner, outwitting and beating the inflation and coming up to your expectations. That is how it says future cash flows discounted at an appropriate discount rate. The formula goes as is given here. Intrinsic value, the discounted model formula, that is earnings per share multiplied by 100 divided by the figure of discount rate in percentage minus the figure of net profit growth in percentage. Discount rate means the required rate of return by the investor. So I have taken a small example here. I have assumed an earning per share of a company is 12 rupees. Discount rate, that is the required rate of return, I have put in at 12%. Net profit growth of the company I have assumed as 6%, which is not very high and not very low. And some companies can be much higher, some companies can be at this level, and very few can be below this also. The required rate of return, I have taken it in a very conservative manner. It can be more than this also. You may get more than this. And 12% will definitely beat the inflation handsomely. And at the same time, it will give you a reasonable rate of return over a long period of time. So with this kind of an assumption, we see that the intrinsic value works out to rupees 12 into 100 divided by 12% minus 6%, which is equal to 200 rupees. Yes, the second formula is based on Benjamin Graham model. This second formula has been extracted from the renowned author Benjamin Graham, considered by the great investor Warren Buffett as his guru. There is a book, friends, by Benjamin Graham, which is a very famous and a popular book on stock market investments. It is known as The Intelligent Investor. If you have time and inclination, please do read it. It is available online. It's a very good book. It's a rather thick one, of course, but you can skip some parts which may not interest you. Otherwise, the book is an excellent guide on how you should go about for investing in stock market and what is a long-term investment. What are the various points and salient features that one must encounter and work out and see when investing in the stock market. Based on this book, I have learned a lot, and in fact, most of my knowledge has come about from this book, and when I applied it practically in the stock market, I found it extremely useful, extremely beneficial. Here in this model that has been shown by Benjamin Graham, intrinsic value formula has been given as EPS multiplied by 8.5 plus 2G within brackets. G means annual net profit growth rate in percentage, which is expected in next 7 to 10 years of any company of which you are reckoning the intrinsic value. So I've taken a small example here again. Same EPS 12 rupees I have used as it was in the first formula, and I have taken G as annual net profit growth rate as 6 that I took in the first formula also. With the net profit growth rate being 6 into 12 plus 8.5 multiplied by EPS. In this formula, we don't have any expected growth as discounted growth was there in the first formula, because it is felt that the actual growth which is experienced by the investor will depend on various factors and will depend on the factual factors, and the investor can decide whether to continue with the company or not. So that has been kept away from the formula, and the actual net profit growth rate has been considered along with the present EPS. EPS also, for your kind guidance, it is not exactly the most prevailing or the current EPS. It is the EPS which is an average of past 3 years or so, or maybe more. 3 years is a very reasonable time to take a average EPS, because most of the business in India or abroad, anywhere for that matter, is having a little bit of a cyclical way of having ups and downs. So 3 years is a fairly good period where an average EPS will indicate in a correct manner what is the earning per share of the company. So this formula is giving the intrinsic value as 246 rupees. So the first formula gave the intrinsic value at 200 rupees, and the second formula of based on Benjamin Graham model has given the intrinsic value as 246 rupees. This is practically the same parameters. Now we see the third model. This is a very easy and a simple one I have made, EPS model. It is a very fast method also for reckoning intrinsic value of any equity share in case you do not have time or do not remember the first or the second form. However, the second one is very good, and this is uh, more or less similar to the second one. It's faster and easier also. You may use the particular industry average price earning ratio if you are buying a share of any industry, whether it is fast moving consumer good, pharma industry or IT industry or infrastructure or cement or steel, any industry, there will be an average price earning ratio which you can probably find from various sources. And you can also get the average price earning ratio of the particular company, again for the past 3 years data I would say, multiplied by your company's EPS. Again, the EPS, what I would say is the average of past 3 years or so, and this will indicate the intrinsic value of your stock. Now, I've taken the intrinsic value equation here. I've taken the EPS as same as 12 rupees, and I have assumed a price earning ratio of 20. 15 to 20, in my opinion, and as you will also possibly come across, is a figure which is quite reasonable in assuming an average price earning ratio of most of the shares of some few industries, barring few of them. Now, this 20 PE ratio is, if it can be said 15 to 20 PE ratio, that it is a fair value for an equity share. 20 into EPS 12 works out to 240. If you make it 15 or 16, it will come to around 180 to 192 or 200, and 200 was also the intrinsic value which came from the first formula. So I would say a range of intrinsic value from these three formulas for this particular script is working out to between 200 rupees to 246 rupees. So it's not very easy to come down to a single figure. There is no accurate intrinsic value for any stock for that matter. It is just an indication of the value of the stock, a fair value of the stock. Compare that with the market value of the stock, and you will get an idea whether the share is underpriced or overpriced or fully priced. So 200 to 246 is a range which you can consider for this particular stock to be a fair value, an intrinsic value, and accordingly you can make a decision whether I should go for this stock now or wait for it to come down to its intrinsic value. And if it is much below the intrinsic value, that means it is grossly underpriced. Being grossly underpriced for a stock also is not a very good indication. You must then find out from various other sources as to why the stock is undervalued, or is it undervalued for a short period of time or for a long period of time. And then you have to take a decision whether the stock is actually of poor quality, staying at such an undervalued manner. So that I leave it upon you. With experience, you will understand that, definitely. And we will also guide regarding that in our future episodes so that you can narrow down a bit more accurately for your decision to buy a stock. Fair purchase price, above three examples, like I just said, show that the fair price to pay for this stock is ranging between 200 rupees to 246 rupees. If you are getting it in the market for within this range, you may consider purchase. So friends, I am sure you must have clearly understood the intrinsic value, its indications as a guidance, and thereby take a decision in purchase and sell of your interest of equity shares. You can try and use these formulas in various companies in your various interests of equity shares, and you can then yourself decide which formula works out very good and easily usable for you, and you can keep using it in future. Friends, in our next discussion, we shall discuss what other factors apart from intrinsic value to take into account before purchase or sale of equity shares. Till then, let me remind you to ensure subscribe to this channel in case you have not done so as yet. And that will provide you with all earlier and future episodes easily on your screen. Do post your comments and queries if any, to which I shall indeed reply. Friends, see you again soon. Have a nice day and happy investing.